Understanding Candlestick Patterns. Welcome to Lesson 10. Today we're diving into the secrets of candlestick patterns, one of the most powerful tools for traders. Understanding candlestick charts will help you predict market movements, identify trend reversals, and make smarter trading decisions. Let's get started. What are candlestick patterns? Candlestick patterns are visual representations of price movements over a specific period. Each candlestick provides key market insights such as opening and closing prices, highs and lows of the session, market sentiment, bullish or bearish trends. Now let's break down the basic components of a candlestick. Basic components of a candlestick. Each candlestick consists of three parts. Body, the area between the opening and closing price. If the close is higher than the open, the candle is green, bullish. If the close is lower than the open, the candle is red, bearish. Wicks, shadows. The thin lines above and below the body, representing the highest and lowest prices reached during the period. Now let's look at some key bullish patterns that signal a potential price increase. Key bullish patterns. Bullish candlestick patterns indicate a potential price increase. Here are three to watch for. Hammer, a small body with a long lower wick, signaling a reversal from a downtrend to an uptrend. Bullish engulfing, a large green candle engulfs the previous red candle, showing strong buying pressure. Morning star, a three-candle pattern where a small red candle is followed by a neutral doji, then a strong green candle signaling a potential bullish reversal. Next, let's explore bearish patterns, which indicate possible price declines. Key bearish patterns. Bearish candlestick patterns suggest a possible price decrease. Watch out for these. Shooting star, a small body with a long upper wick, signaling that buyers failed to maintain momentum. Bearish engulfing, a large red candle engulfs the previous green candle, showing strong selling pressure. Evening star, a three-candle pattern where a small green candle is followed by a neutral doji, then a large red candle, indicating a potential bearish reversal. But how do we use these patterns in trading? Let's find out. Using candlestick patterns in trading. Candlestick patterns are most powerful when combined with other technical indicators like Relative Strength Index, RSI, helps confirm overbought or oversold conditions. Moving averages, identifies trend direction to validate the pattern. MACD, helps confirm the strength of trend reversals. Using multiple indicators helps filter out false signals and improves trade accuracy. Action plan for the week. Now let's apply what we've learned with this weekly action plan. Learn basic patterns. Study the key bullish and bearish patterns. Analyze real charts. Use TradingView to spot candlestick patterns in action. Combine with indicators. Add RSI, MACD, or moving averages to your analysis. Practice trading. Use a demo account to test trades based on candlestick signals. Keep a trading journal. Document your findings and analyze what works best. Mastering candlestick patterns will give you an edge in crypto trading. Understanding candlestick patterns is a game changer for traders. These patterns help predict price movements, identify reversals, and make informed trades. Have questions? Drop them in the comments. Like, subscribe, and turn on notifications for more expert crypto insights. See you in the next lesson.